Hello, and you're welcome to this global business channel that brings to you on our regular Global Business Insights episodes the main business news stories plus perspectives by experts and seasoned senior analysts on the headlines. This edition is a special one focusing on today's top Nigerian business news as we get positive economic data from the economy and the Central Bank Monetary Policy Committee decision to hike interest rates once again in its last meeting for the year. But first, some of the other news making the headlines. Donald Trump will levy tariffs of 25% on all U.S. imports from Canada and Mexico, plus an extra 10% tariff on Chinese goods. This is in retaliation for illegal immigration and drug trafficking. Chinese officials have responded by saying no one will win a trade war or a tariff war. Asia Pacific equities mostly declined following the tariffs announcement. Federal Reserve Bank of Chicago President Austin Goolsbee said yesterday that he foresees the Fed continuing to lower rates toward a stance that neither restricts nor promotes economic activity. Minneapolis Fed President Neil Kashkari also said it is still appropriate to consider another interest rate reduction in December. Yesterday, UK Chancellor Reeves told skeptical businessmen at the Confederation of Business Industry annual conference that she had no regrets about her fiscal decisions. Some executives had said they were caught off guard by the tax hikes and warned they were reconsidering investment plans. In a press statement, President Bola Tinubu assured Nigerians of better economic output as the economy continues to expand following the newly released Q3 Gross Domestic Product report by the National Bureau of Statistics. According to the report, Nigeria's GDP grew by 3.46% compared to the 3.19% growth recorded in the second quarter. The performance of the GDP in Q3 of 2024 was driven mainly by the services sector, which recorded a growth of 5.19% and contributed 53.58% to the aggregate GDP. The data, according to the press statement, indicates Nigeria is recovering from the reform's unintended effects and on track to deliver the promise of a $1 trillion economy by 2030, noting also that the GDP will be rebased by early 2025 to capture its dynamism. But Nigeria's debt stock, a heavyweight on the economy, both external and domestic, grew over 10% quarter on quarter. The debt stock stood at 134.3 trillion naira. That's $91.35 billion. Also, in the second quarter, unemployment rate was 4.3% from 5.3% in Q1 2024. Still, although July to September GDP looked good, the government was mute on the very latest October PMI, Purchasing Managers Index, from both the central bank and the Stanbic IBTC S&P data, which showed the private sector economy slipped further into contraction. Just reported, Italian lender Banco BPM has rejected rival UniCredit's takeover bid. We continue to watch that space. But back to our deep dive with a flurry of economic data on Nigeria coming in ahead of the Monetary Policy Committee decision today. There was a lot to digest, I'm sure, as the committee decided to hike rates by 25 basis points to 27.5%. Let's hear what the Central Bank Governor, Mr. Yemi Cardoso, had to say today after the rates decision.
The committee was unanimous in its decision to further tighten policy and thus decided as follows. 1. Raise the MPR by 25 basis points to 27.50% from 27.25%. 2. Retain the asymmetric corridor around the MPR at plus 500 to minus 100 basis points. 3. Retain the cash reserve ratio of deposit money banks at 50% and merchant banks at 16%. 4. Retain the liquidity ratio at 30%. Considerations. The meeting was held on the backdrop of renewed inflationary pressures as the headline food and core measures rose year on year in October 2024. The committee was particularly concerned that all three measures also inched up on a month-on-month basis, suggesting the persistence of price pressures with attendant adverse impact on income and welfare of citizens. Members, therefore, agreed unanimously to remain focused in addressing price developments. While food prices remain a key contributor to the uptick, members commended the efforts of the federal government for the improved security, especially in the northeast of the country, which would likely improve food production. The committee also noted the role of rising energy prices on the general price level due to its impact on factors of production. The recent increase in the price of premium motor spirit, PMS, has also impacted the cost of production and distribution of food items and manufactured goods. The committee was optimistic that the full deregulation of the downstream subsector of the petroleum industry would eliminate scarcity and stabilize price levels in the short to medium term. Members thus reiterated the need to strongly forge ahead with the deepening collaboration between the monetary and fiscal authorities to ensure the achievement of our synchronized objectives of price stability and sustainable growth. The committee noted the improvement in the external sector, reflected by the increase in the current account surplus, enhanced remittance and capital inflows, which have impacted the external reserves positively. This, therefore, suggests that key policy measures by both the monetary and fiscal authorities are yielding the desired outcomes. Members, however, expressed concern over persisting exchange rate pressure, reflecting continued high demand in the markets. Consequently, the committee urged the bank to explore measures to boost market liquidity. Members noted with satisfaction the continued resilience and stability of the banking system, despite significant exogenous and endogenous headwinds. Key financial soundness indicators, such as the capital adequacy ratio, CAR, non-performing loan ratio, NPL, liquidity ratio, LR, amongst others, remain strong. The MPC, however, called on the bank to maintain its close surveillance on the banking system to sustain compliance with regulatory threshold and continued health of the industry. The MPC acknowledged the efforts of the bank in deepening financial inclusion towards improving the transmission mechanism of monetary policy to enhance policy effectiveness. From the foregoing, members thus focused on the optimum policy choice to address the uptrend in price development, stabilize the exchange rate, and anchor inflation expectations appropriately. Key developments in the domestic and global economies. Data from the National Bureau of Statistics showed that headline inflation year-on-year rose to 33.88% in October 2024 from 32.70% in September 2024. On a month-on-month basis, it also rose to 2.64% in October 2024 from 2.52% in the previous month, with both the food and core components contributing to the continued rise in headline inflation. Food inflation rose further to 39.16% in October 2024 from 37.77% in September, while core inflation also rose to 28.37% in October 2024 from 27.43% in September. The MPC, however, noted the moderation in the prices of farm produce and commended the efforts of the federal government in driving increased productivity in the agricultural sector.
Like we just heard, Governor Olayemi Cardoso told reporters in Abuja that the Monetary Policy Committee decided to lift the benchmark rate by 25 basis points to 27.5%, reiterating that the main role of the central bank is monetary stability. Most analysts expected a more hawkish 50 basis point hike, noting that the stronger than expected Q3 economic growth will encourage an extension of an over 2-year tightening cycle to temper inflation. Others were of the view that the latest weak October Purchasing Managers Index data will tone down the hawkishness, which may explain why we got 25 basis points instead of 50. That also perhaps is a signal of nervousness with the growth trajectory. Also noting that the latest IMF GDP growth data was revised downwards. There was optimism on the business and investment climate in the central bank governor's tone, but very little details we got on guidance on GDP growth, which is very unusual, especially the central bank's update 2024 GDP projections and also on inflation metrics. Reserves, we understood, are going up, albeit moderately, and the economy is showing obvious resilience, but this resurgence in price pressures means the battle is far from over. Well, that's all we have on this special episode of Global Business Insights. This is Bode Oshosami. Thanks for sharing on Facebook, LinkedIn, X, and YouTube. And again, thank you so very much for watching. Bye-bye.